company is using this part for redemption purpose. Suppose a company is getting 50,000 rupees profit in the P&L account. So company can use that part of profit from their operating activities to make a redemption of debenture. But in this case, company will never pay a part of dividend to the shareholders. In this case, these entries generally company do for redemption out of profit. First, company will transfer the part of profit to a reserve known as debenture redemption reserve. For this, the journal entry is profit and loss appropriation account debit to debenture redemption reserve account. Means company will specifically create a reserve for the purpose of redemption out of profit. And secondly, company will pay the funds in cash to the old debentures. For this, entry will do debenture account debit to bank account. Means company is entitled to use their profits. First, company will transfer to a specific reserve, and then that reserve will use for repayment to the old debentures. Now this is the second category which company use, redemption out of capital. In case of this method, no amount out of divisible profit is company using for redemption. The divisible profit is therefore not reduced, and that will be transferred for dividend payment. But company will straight away use their capital for payment of redemption to the debenture. In the earlier method, company used their profits for redemption and they have not paid anything for dividend point of view to the shareholder. But in this case, all divisible profit will go for dividend to the shareholder and capital will use for redemption point of view. And for this, following entry will be passed out in front of you: debenture account debit to bank. In the earlier phase, first we transferred something to the debenture redemption reserve account, and then we actually used that part for redemption. But here the all amount is going from capital, so there is no need to create a reserve, and 100% figure is going out of capital, known as debenture account debit to bank account. Now next method is conversion of debentures to be redeemed into new debentures or shares. This is called redemption by conversion. This is the next category. As two category we discussed earlier, first we have done it out of profit, secondly we have done it out of capital. In this category, the old debentures will convert it into new shares or into new debentures to make the redemption. So therefore this method known as conversion method. This method gives an option to the debenture holder to get the existing debentures converted into new shares or into new debentures. Means here company will give an offer to the old debentures to convert their debentures into new equity, into new stock. Either they convert it, they can choose an option of preference share, they can choose an option of equity share, they can go ahead either with the cash. For this, if debenture holder is exercising this option, this entry will pass out: old debenture account debit to new debenture account or to share capital account. If suppose they are just choosing new debenture, then new debenture will credit. If they are choosing new share capital of equity or preference share, they will come in the credit side. But it depends on the exercise of the option. And if suppose debenture holder are not willing to just convert their debenture, then definitely cash will be paid to them. Means rest debenture holder will get the cash if they are not willing to convert their debentures. So this is the third method known as conversion method for redemption. Next is redemption out of proceeds of issue of new shares or debentures. The company may offer to the general public for subscription of new shares or debentures and redeem the old debentures out of the funds raised. This is the next category. We have discussed three categories. First we used profit for redemption, second we used straight away capital for redemption, third we converted old debentures, and this is the fourth category. Here actually you want to pay something to your old debentures, therefore you are just issuing your new shares, either your new debentures, to get the funds, and receiving funds you will use for repayment to your old debentures. For this, new capital will be properly utilizing for the redemption of old debentures. The accounting entries for issue of new capital will remain same. Suppose a company is going to issue new shares of equity, then same entries we will do in the book particular of company, like application, allotment, and first call and second call. But for redemption point of view, whatever funds you have been raised from new shares will go to the debenture holder, and entry is debenture holder account debit to bank account. So this is the simple entry which actually will be passed out for redemption purpose if suppose company is going to issue new shares for raising funds. Now the next method is sinking fund method. In case of sinking fund method, every year company a fixed amount company transfer into a particular account known as sinking fund, and they are transferring this fund every year particular to invest that fund in the securities out of the business. When the time of redemption of debenture comes, these investment which you invested earlier and outside will sell, and the sale proceeds will use for redemption of the debenture. Simply it means, suppose you know that after 5 years you will have to pay something to the debentures, so every year a certain amount will transfer to the P&L appropriation account, and that amount of profit will invest outside of the business in some securities, in some bonds or stocks, and this will be an asset for the company. So when the time of redemption will come, this investment will be sold by the company, and the realizable value will be actually used for the redemption purpose. For this, you can just divide two types of your sinking fund. You can either go ahead with cumulative sinking fund, either you can go ahead with a non-cumulative sinking fund. Again, for example, if a company is carrying 1 lakh rupees debenture capital, he knows that after 5 years they will have to pay to their debentures. So therefore, with a certain rule, they are every year using their part of profit, a certain part of profit, and they are transferring that profit to the P&L appropriation account. Suppose they are transferring 15,000 every year to the P&L appropriation account, and then this figure is going to invest somewhere outside in the business, so that will be an asset for the company. So at the end of 5 years, company will have 75,000 rupees principal amount, and definitely that figure was invested somewhere outside the business, so company is also getting cumulative interest, and that figure will be equivalent to the principal amount of debenture which company has to pay to the debenture. So this will be equivalent two types, either you can go ahead with cumulative, either you can go ahead with non-cumulative. Next is insurance policy method. Under this method, company may take an insurance policy in place of purchasing investment. In the earlier method, we actually took some figure from P&L appropriation account and it was invested in some investment options. But here company is not purchasing some investment. Straight away company is taking an insurance policy for the redemption point of view. The policy will be taken for a period which will enable the company to get the required amount on the date of redemption. Suppose a company has to pay again 1 lakh. In the earlier example, every year company purchased an investment of 15,000. But in this option only, company is taking an insurance policy of 1 lakh at the beginning of a year, and for this every year company is paying premium. So at the end of 5 years, company's policy will mature and company will get the funds, and that funds will be used for the redemption purpose. The amount of premium will have to pay in the beginning of the year here, and no entry will be passed out for the interest, because on investment every year you are getting interest, and that was actually on cumulative or non-cumulative method. But in case of insurance policy method, only company will have to pay premium at the starting of year and no interest will get by the company. So this method is to some extent simple as compared to sinking fund method. So these are basically, we are carrying the methods to use redemption. First was out of profit, second was out of capital, third we converted something, and in fourth we issued new shares or debentures to get the funds. Then we moved with the sinking fund, and final we have taken an insurance policy to redeem our debentures. So this is all for debentures. Here we discussed the concept, characteristics, the process of issue, the process of redemption, types of redemption, and even we have discussed various differences between debenture and bonds, debenture and shares, debenture holder and shareholders. Thank you very much. Hello everyone. In this video, we will study about inventory valuation and inventory management. The contents which we will take and study is, first we will study what is the meaning of inventory, what are the objectives of valuation of inventory, then we will take what is the system of inventory, then finally we will study methods for valuation of inventory, and finally we will take objectives of inventory management with various methods. First is the meaning of inventory. Inventories are generally known as stock, and stock means which is unconsumed or unsold goods which were purchased or which were actually manufactured. Means if suppose you have purchased 10,000 quantity but you have sold only 9,000 quantity, it means 1,000 quantity is known as stock. And parallelly you can understand, if you have manufactured 10,000 quantity and you have sold only 9,000 quantity, in the same example 1,000 quantity will known as manufactured stock or inventory. According to Accounting Standard 2, which is revised, the meaning of inventory is 1. Which is held for sale in the course of business. Means whatever you are keeping with you particular for the purpose of sales, known as inventory. Second is in the process of production for such sale. What you are keeping, if suppose you want to use it for the production or sales in future, again this is known as stock. And third, if suppose you're in the service sector, you are keeping some materials or supplies particular for rendering the services, they are also known as inventory. So in crux, the meaning of inventory is stock and basically known as unsold goods or unconsumed goods. Now, what are the types of inventory? Inventory are popularly known as stock, as I said earlier even. There are three types of inventory or stock you can take. One is finished goods, second one is work in progress, and third category is raw material. So we will take in discussion from raw material in descending manner. Raw material is that which actually you purchase as an input to convert into output. So if suppose at the end of the year, if you are keeping some raw material with you, so they will come as unconsumed goods under the type of inventory. Work in progress is a process where you are actually converting your input towards output. So at the end of a year, if suppose your process is running and something is in the process of WIP, will known as inventory. And third category is finished goods. It is that which is known as stock basically, because it was not sold by you, it was actually keeping by you in the store, known as finished goods. So these are three categories to understand the types of inventory. Now, what are the objectives of inventory valuation? Means why actually we are making a valuation of inventory in accountancy. First is, if you want to calculate your income, so this is very important first essentially to desire to understand the valuation of inventory. The valuation of inventory is necessary for determining the true income which is earned by a business during a particular period. For example, if suppose you know that we are carrying three types of final account: trading account, P&L account, and the balance sheet. Trading and P&L account, they reflect with the level of profit, and balance sheet finally shows the financial position. In trading account, at the credit side, we reflect always closing stock. If you are not getting the true valuation of your stock, it will reflect the amount of profit or loss. So valuation of stock always actually affect the valuation of income. Secondly, if you want to know the financial position, essentially you need to understand, you need to calculate the valuation of inventory. Financial position always we calculate or we get through balance sheet. In the balance sheet and asset side, we show always inventory as a part of current asset. So again, this is essentially desire to calculate inventory valuation for both the purposes: first to calculate the financial income, and secondly to calculate the financial position. Now, what are the inventory system? Inventory system for record of quantity and value can be actually mentioned can be taken as two types. Means if you want to know inventory in quantity or if you want to know inventory in value, for both the purposes you need to move with two system. One is periodic inventory system and second one is perpetual inventory system. In periodic inventory system, actually you calculate the quantity and value of inventory only at the end of accounting period. Means if suppose you're going to close your books of account, so only at that day you will calculate the value of inventory as well as quantity of inventory. And for this we use the sequence. First we take the opening stock, then we add how much we actually purchased as stock, and finally what we are keeping as closing stock. The difference is between known as the end of the day as inventory valuation. The system does not provide the information of stock on a continuation basis. This is actually the drawback of the system. The system provides the information about quantity as well as value, but at the end of the year it will not give you the information on a continuation basis. Now this is the example to calculate periodic inventory. If suppose the inventory in the beginning was 1000 unit of rupees 10,000 purchased during the year were 5,000 unit of rupees 50,000, and the closing inventory is 1500 for rupees 15,000. So here we will calculate the actually valuation of inventory through periodic. In this case the cost of material is rupees 45,000. Simply what we have taken, actually 10,000 is opening stock of 1000 unit and 50,000 we purchased for 5,000 unit, and finally we reduce from 60,000 rupees 15,000 which is closing stock, and we are getting 45,000, which is known as valuation of inventory on behalf of periodic system. Now if we will move with the second method known as perpetual inventory system. It is also known as automatic inventory system, and this is very different from periodic system. In periodic system we calculated the result at the end of the year, and that was the drawback of the system. But through this system you will get the information of inventory valuation either in quantity as well as in value on a continuation basis. So after getting every receipt of inventory and after issuing every kind of inventory, we actually check on behalf of perpetual system, we calculate stock and the business. So this is a beauty of the system. The system provides the information of stock either for raw material, either for WIP, either for finished goods on a continuation basis, because we always get to calculate it after every receipt, after every kind of issue. So the basic objective of this system perpetual is to calculate quantity and value of each stock at all times. So every time you will have the updated information about your inventory, and which are essentially desired to calculate your financial position as well as your financial income. Now how we actually do the valuation of inventory. According to accounting standard 2, if you need to value actually your inventory, so the cost will be the lowest of either historical cost, either net realizable value. Means whatever is less in between two item, either the cost of the output, either the realizable value of the output, and whatever is less known as actually the value of inventory on behalf of accounting standard 2. So this is important. Whatever will be less, that will known as the value of stock. Now what are the methods of inventory valuation? These are 6 methods which we will take in study one by one. First is specific identification method, then there is FIFO method, then LIFO method, then highest in first out method, then NIFO method, next in first out method, and finally we will study weighted average price method. So first is specific identification method. According to this method, each item of stock is carrying and individual costing, and they can identify with that. Means if suppose you are keeping 10 types of stock in your store, so we can identify each kind of category with their own cost, because that was purchased by us on different costing. And this is the symptom of this system, that you will take the different cost of different quantity. This method is generally used when the material or goods have been purchased for a specific job or for a specific customer. For example, if suppose you are having a furniture shop and you have purchased 10 beds for a customer, and they are right now keeping in your store, so you can identify that these are particular for that customer. So this method specifically apply in that case only. This technique of inventory valuation can be adopted only by a company which is handling small number of items, because if you are doing your business on large number, this is really very tough for you to identify particularly each item with their individual cost. If you are doing your business on small level, this is the easiest method to apply for inventory valuation. Next is first in first out method, known as FIFO method. Under this method, it assumes that the material or goods which receive first by us are the first to be issued or sold. Means whosoever actually come first, that will go out from your business first. This is the simple system of this concept. For example, if there were 3 purchases or a shift of goods of 200 units, 100 units or 300 units on 10th February, 14th February and 20th February respectively. Means on 10th February you actually got 200 units, on 14th you got 100, and on 20th you got 300 units. Now for example, if suppose on 21st February you need to issue 225 units, then on behalf of FIFO methods, how we will take the decision? So the decision is, first 200 units will issue and rest 25 will go out from the batch of 100 units, because we know we are applying here the FIFO, and in FIFO we assume that whatever we actually received first, that will go out first. So first we actually received in this particular case on 10th February 200 units. So for issuing of 225 units, we will use that 200, and rest 25 will use from the batch of 100 units, because it came before 20th on 14th February. So at the end of this question, if suppose we will take what actually we are keeping in store, so we will keep actually 75 units and 300 units of 14th February and 20th February in the store. Now the next is LIFO method. Whatever we received last will go out first. This is actually the assumption of this method. Thus, according to this method, inventory consists of items purchased at the earlier cost. Means here the meaning of inventory cost is simply that value which we actually received on the earliest date, because whatever we have received in the last, it was issued by us on behalf of last received go first concept. Again, for example, we will take the same example what we discussed for FIFO method earlier. We received three kinds of category: 200 units, 100 units and 300 units on 10th, 14th and 20th February. If suppose we need to issue 225, so in this case the answer is that 225 units will go out from a single batch of 300 units which we received on 20th February. So this is a very different answer from FIFO method. In FIFO we actually issued first 100, then we issued from the next, first we issued from 200 units, then we issued rest from 100 units. But here we are taking the last batch, because this method assume what we have received last will go out first. And parallelly in this method, in store we will keep actually the units. First we will keep the 75 units from 300 batch, then 100 units, then 200 units we will keep in the store. Now, what is the difference between FIFO method and LIFO method? The first difference, this is very simple, issue of goods. In LIFO we actually used to issue those which we received last, but in FIFO we do reverse actually. What we have received first, we issue them first. The second point is cost of goods sold. In case of LIFO method, the cost of goods sold represent the cost of recent purchase. Cost of goods sold means whatever sold by you, what was actually their cost. So it simply means that in LIFO we issued those which we received in last. So definitely the sold of value is the value which we received in last. But in FIFO method, what we received in earliest date will be the cost of goods sold. And third point is closing inventory. This is very reverse from cost of goods sold. In closing inventory, particular for LIFO, we will keep the stock in store what we actually received on the first day. But in FIFO method, we are keeping in store what we actually received on the last day, because the rest part has been issued already. So these are three differences in between FIFO method and LIFO method. Now, the next one is highest in first out method, HIFO method. Material goods which purchased on the highest figure will go first issue under this concept. So here the inventory of material or goods should be valued at the lowest price. It's again very simple. If suppose you are carrying two types of quantity in your goods, one was for 25 rupees each unit and next one is 30 rupees for each unit. So 30 is actually having the highest value as compared to 25. So first we will issue for 30 and 25 is the less, so it will keep as a stock in the store. This method is very suitable when the market is constantly fluctuating or when there is an inflation trend, because due to that you will be able to match exact cost what has been paid by us. Now next is next in first out method or NIFO method. The method attempts to value the material issued or goods sold at actual price which is very near to the market price. It simply means if suppose you are keeping again two types of quantity, so you will not actually just consider their cost, you will see the market value and to the nearest of that market value you will issue the goods. Under this method the issue